Welcome back to another weekly episode. So, this is where we had left our discussion last time around that the market will eventually start climbing the great wall of worry. And we'll continue forward with what has happened in the last 15 odd days. I could not give an update last week because I was traveling. So, a lot of things have happened. So, this is my Instagram ID, st_PYI, in case you want to discuss something with me that you cannot write in the comments section below. So, the first thing we'll understand is what is recency bias and how it adversely impacts your portfolio in multiple ways. This is going to be handy in 2025 and 2026 because if you think what you've seen in the last 3 odd months is over and now we are going to have a smooth trend ahead, then you're certainly wrong about it. So, recency bias is a cognitive bias that causes people to give greater importance to recent events or outcomes while ignoring the long term trends, historical data, or fundamentals. In the stock market, this often leads investors and traders to overreact to short term price movements, news, or market volatility, misjudging the true nature of a company or market environment. In this day and era, this is happening more than ever in terms of historical perspective. The reason being that social media, WhatsApp, Telegram, X, Instagram, they all make it very easy for you to read other people's opinion. A lot of news is always highlighted in big, bold red letters. The reason is simple: it inflicts a lot of damage in terms of engagement. That is, the person who's making all this is getting a lot of engagement from you because your mind is positioned this way. You have to stop overreacting to the market. Typically, after seeing a fall of 10% or more in a week, the recency bias tells investors to sell off their high quality stocks out of fear, simply thinking that another global financial crisis or a COVID kind of vertical drop is coming. In both these instances, that is the GFC 2008 and COVID, yes, the market fell 37-40% in a month. That is in COVID. It recovered immediately in the subsequent few months. In 2008, in October, when the final number of the market fall was 47-50%, by March 2009, April 2009, markets were back to where they were. So the thing is, recency bias is something that impacts majority of investors and traders more so in these times because of social media. And this is something you have to protect yourself from. The only way to do this is to focus only on the medium to long term. That is, you have to focus on strong earnings, trends, valuations, whichever sectors you see are breaking out. Those trends take time to play out. Never forget that humans are wired to respond to what just happened. But in the market, that instinct can be your biggest enemy. That is reacting to day news, day gap downs, and taking long term decision based on short term news. Now, this brings me to the question: how do you prevent recency bias from damaging your portfolio? There are only two ways to do it. Number one, mitigation and adaptation. Mitigation is you need to have a written trading and investment plan. Define your entry, exit, risk management rules based on strategy, not on emotions. Use fundamentals and technical setup. Every trader is different. They'll use a combination of these and the macro context to ignore the noise and stay with your positions till the time trend is valid. Stay away from short term market commentary. See how this has flip flopped in the last 30 days. I would like to tell you that in the last 30-45 days, since the market has seen tremendous amount of volatility, whichever news source you track, whoever you track on social media, look at how they have flip flopped. And majority have done so. I'm not saying everybody is like that. But the reason being that they are also impacted by something like recency bias. So you need to have your own hypothesis about what may happen in the economy and market in the next 12, 18 months and not let 5-minute, 15-minute, 60-minute charts dictate that. So when it comes to adaptation, you need to zoom out, check weekly, monthly charts instead of smaller time frame charts that are now immensely popular. You need to document your trades and emotions during market moves. This helps you spot patterns of bias that you can eventually weed out of your trading plan and stick to that plan. Now, why do majority of investors and traders fail? Because I can guarantee and tell you that over 90% don't have a written trading investment plan. Over 90% don't even document what kind of trades they are doing and why they are doing that. It's always a recency bias factor. Which stock is moving up fast? Let's go and buy that. Which sector is breaking out? Let's go and buy that. That is not how sound investment and trading decisions are made in the market. Now, stock market loves the wall of worry. I had done a complete dedicated 5-minute section on wall of worry in the last week's episode. I won't repeat it. But for the next 6 odd months, you need to keep certain things in mind. Number one, the news will remain negative. See, Trump tariffs were short term in nature, they hit the market, the effect was short lived, but volatility will return again because no one truly knows what is going to be the impact of tariffs on American economy, on global economy, how world is going to react, what kind of earnings downgrades are going to come in the market in the next 4 or 5 months. So that is something that is yet to be priced in. Markets will ignore the noise. Now, in the short term, while the market makes a lot of noise about short term news that comes out, in the medium term, the market will ignore the noise. And those sectors and stocks that are showing strong relative strength, that are making higher high and higher low, will keep moving up with bouts of volatility in between. Global liquidity still remains strong. I've put the asterisks out here because the recent Fed commentary, based on what is happening in terms of policy in the US, was a bit negative because Chairman Powell was stating that he himself does not know what is going to be the impact of tariffs on economy in general, what kind of inflation rise he's going to see. So this is something again you'll have to keep in mind, and this is why the markets will remain volatile. Now, a line or two about smart investors. As fear rose, the S&P and global indices began quietly grinding higher, especially when the VIX in America hit, I think, 57 or 56. That is where a short-term bottom at least has been made in 2008 during COVID fall and even the dot-com bubble. Why? Because markets climb the wall of worry. When sentiment is low and headlines are scary, positioning is light, this is when smart money accumulates. And the easiest way to see where institutions are betting is sectors and stocks where relative strength is clearly trending higher. I'll put out some charts later. So, in the last 15 to 30 days, we've seen a lot of short term traders getting trapped. This is a point I've repeated many times, that short term traders are going to get butchered in this market. And this is going to remain true for the next 6 odd months. I just don't see how volatility and this uncertainty is going to go out from the stock market. In between, like we saw in last week of Feb and entire March, we had a wonderful rally. Currently, we are having that beautiful phase again in the market. But retracements will happen. That is the nature of stock markets. So in the past 15 days, short-term traders were chopped up by whipsaws, false breakdowns, fake news-driven volatility, and rapid reversals to stop losses, and punished those without conviction or risk control. The era of short-term trades is gone. Algorithms dominate short-term moves. News flow dominates in the short term. Retail must either evolve or step back to longer-term structured strategies. This is the theme for the next 24 months. If you don't catch on this in terms of having a medium term to long term view, your recency bias will keep making your portfolio go down. And this trend won't change anytime soon. If you think markets won't fall from here, this is again your brain being programmed by people who give short term commentary. The cycle is going to be tough. There's an interview by Professor Raghuram Rajan and Fed Chair Jeremy Powell that has come on YouTube. I'll link it up here. Go through that without any biases. Just listen to what Chairman Powell has to say. So, what is the key takeaway from the last 15 odd days? The headline is discipline over drama. The takeaway is that recent rebound that has happened in the stock market tells you that discipline will always beat prediction. It will always beat short term noise in the market. Now, what about new low? Which sectors have made a new low when the Trump tariffs were announced? Were these sectors already weak? If you go and check the chart of those sectors that made a new low, except metals, all those sectors were having immensely poor relative strength. That is, those sectors were already underperforming. Which sectors have now made a new high? Are these those sectors that were showing strength when the market were heading higher earlier? That is, during Trump tariff announcement also, which sectors were showing high relative strength? Have they made new high? Yes. New swing high and lifetime high has been made by banks, finance, defense, tourism, and there are some other sectors also, but these were the sectors that were already having strong relative strength in the market. So there are some key lessons for the future that you have to take note of. The thing is that flip-flop in the market is going to continue. You will see gaps on the chart. Currently, you're seeing gaps on the upside. You will start seeing gaps on the downside also. In certain sectors where relative strength is poor, you will still see new lows being made. That is the nature of how bear markets play out. But one thing is clear, that ignore the noise, follow the trend, and respect the data. Be prepared for pivots. Whichever sectors are taking out pivots on the higher side, those are the sectors that are going to do well in the next 12, 18 months. Some charts I'll put out. So first chart that I'll put out is a sector that did not work out. So the four key sectors that I discussed in Jan, IT I had discussed, but IT went below 50 DMA and the pivot, so the trend got violated. Other sectors were metal, banks, and finance. These are core sectors. There are some supplementary sectors also which were holding up very well, which is Nifty Defense, Nifty Chemical, Nifty Tourism also, which includes hotel stocks, airline stocks. So metals actually saw a sharp retracement when the Trump tariffs were announced. I'm still bullish on metals. I don't think that metals are going to underperform a lot in the next 12, 18 months. This is a blip. A lot of things will get sorted out over time. There are already some indications that China is going to pump up their market in terms of more liquidity. And I just don't see how the Chinese economy is going to do well and the metals are going to do poorly. So metals, I'll still stick my neck out and tell you that metals over the next 12, 18 months are going to be one of the sectors that is going to surprise. So the first one I pulled up was the sector that did not work. What has worked? Nifty Finance. I did not put out the RS chart because it's very similar to Bank Nifty chart, but look at what finance has done. And finance was giving you so many indications. Look at something like Bank Nifty. Look at the RS. So this is what smart money means, that when price is heading lower, it heads lower with less momentum, more of accumulation. That is why RS keeps rising up. And 3-4 weeks back, when I had made a video about Stan Druckenmiller and how he picks out stocks in bear markets, there were three things I told you that is working for us. Liquidity. RBI is flooding our economy in terms of liquidity, easing liquidity, that is. It is supporting economic growth. GDP and inflation were also in line. What was not in line was sentiment. Whenever these two pockets align, always keep banks, finance, stocks in mind because they are eventually going to do well. The problem is again with recency bias, because when I put out that data, Bank Nifty was somewhere here. You will never get a scenario where things will play out based on news, which means RBI is pumping up liquidity. From tomorrow itself, Bank Nifty starts going up. That is not how stock market works. These are data points that align over time. And then when sentiment improved, look at how banks and finance stocks have taken off. I was expecting metals also, but everything cannot work. Nifty 500, if you check my Instagram feed last week, I'd put out a W pattern kind of formation that is happening in Nifty 500. Go and check that chart. I have explained a lot in description section. This is a William O'Neill W pattern. It will get confirmed above 21,900. The volume patterns are there. You're seeing pickup in volume as price is moving higher. When the price gap down, look at the volume trend. Now again, volume is trying to pick up. So this is again something you have to keep in mind. If this pivot goes out, the next logical point where the pivots will pull price is somewhere between 22,900 and 23,300. Remember, this is still a lower high, lower low structure. Then Nifty India Defense. Again, look at the RS improvement that has happened in the last 2-3 months. This is a new swing high that is being made in Nifty India Defense. This is a tight contraction also because there is less amount of data for Nifty India Defense Index. That is why this seems a bit V-shaped in nature. But had we had proper weekly charts, this would have been a beautiful cup and handle also. Nifty India Tourism, again, very similar structure. Can you see? Excellent relative strength. The message from the market is very clear that there are pockets where strength exists and those pockets over time will keep doing well. Again, your recency bias will make you trade short-term instruments in Nifty Bank or in Nifty Finance. That is going to be a huge mistake. When such structures play out, where Nifty Finance has moved to all-time high after some bit of contraction, consolidation, this is also very similar to a cup and handle breakout. Again, this chart I had posted on Instagram. Look at the volume spike that is coming up. These are structures for the next 12, 18 months, which means in between, whenever President Trump or President Xi's, depending on their mood, if they're in good mood, the trend will continue with less volatility. If they wake up and start doing something that is not favorable for the market, even these sectors will see sharp pullbacks. When the pullback happens, that is a cue for you to start looking in these sectors, not when everybody is looking here. If you weren't paying attention to relative strength when it was rising between Jan and March and you just did not do anything because the markets were falling, then this is certainly not the time to do anything. You need a proper pullback. And this brings me back to the topic of why I always remain a buyer in stock market or bullish on stock market. Bullish does not mean going ahead and picking up a lot of positions. Bullish means preparing for something that may change in the market. If currently you look at the market breadth data, 50 DMA, 60% stocks are above 50 DMA. This number has improved, but we need to sustain above 60, 75% stocks being above 50 DMA. 200 DMA, only 23 stocks are above 200 DMA. This still tells you that the market is not in a pure bullish territory yet. Only 20% stocks are above 200 DMA. It also tells you will get a lot of time to build positions whenever the pullback comes. Number of stocks that are in higher high, higher low structure is just 25%, which means 75% stocks are still in a lower high, lower low structure. It tells you the kind of market that has played out over the last 4-5 months. Massive amount of correction. Some pockets have done well. Some pockets are pulling away from 200 DMA, breaking out to lifetime highs. Those are the pockets where you have to focus. Why? Because that is market telling you to focus on that pocket. Not me, not some other analyst, not some other commentator. It is the market telling you that you need to focus on banks, finance, tourism, defense. And yes, structures can fail. Stock market is not a guarantee, it is always a probability. And you need to identify technical data points and fundamental data points that increase the odds of trade working in your favor. It is always about that. So when it comes to the outlook that I have given, I'll still remain consistent. Between March and September, we will have a leg up in the market. Yes, the market came down again and made a new low, but look at where it is. That is why last episode also I had given you a clear message. Don't be slave of short-term news. Market is again back to where it was, in fact, higher when Trump tariffs were announced. So this is my broad kind of educated guess that may play out in Nifty 500, that we'll keep moving up with volatility. We will revisit this region somewhere between September to March, and then probably a sustainable move can begin in the market. That is just how I see today based on data points that are there on the charts. But when this pullback happens, the stocks that have already moved to all-time high are not going to come back here, which is why you always have to buy in smaller quantities. Do you think the stocks in banks and finance or maybe in defense are again going to come back to these levels that was seen in Jan or Feb? They won't. That is why you need to buy. You need to be a buyer in stock market when the conditions are not right. Keep your position sizing small, but gradually accumulate those stocks and sectors that have beautiful relative strength on the upside. Stocks that are moving into a higher high, higher low structure. Stocks that are moving towards all-time high or at least a 52-week high. This is a simple template that has worked for generations as shown by William O'Neill and Stan Weinstein. And I see no reason why this is going to stop working. The only difference is in terms of discipline, patience, and in this era, not being slave of short-term news flow or the things that you see on X or Instagram or any other platform. All right, so comment sections are open. Please bring in your comments today itself. I'll try and answer as soon as possible. Have a great weekend ahead. Take care, be safe, and keep your notifications on for future updates.